I like to think of everything you save and invest as going into one of two different buckets. I'm going to label one of these buckets safe money, and I'm going to label the other bucket as risk money. Let's define these two buckets because they're often misused. People often think of a piece of money goes in one bucket, it really should be in the other bucket, and then they have their parts in a plan, but there are challenges with monies that go in these buckets. But first, let's define the buckets. The way I define safe money is ideally you have a guaranteed return of principal. Now, then you've got to look at who's backing the guarantee. And then if it's not guaranteed, it needs to be very, very stable. So in other words, that money's not going up and down with the stock market. So if and when you need money, you know that money's going to be there for you. It provides some certainty or stability in your plan. Now then, the risk bucket has no guarantees. Most people in or near retirement need to have a pretty decent mix of both, because what safe money does is it provides for certainty when there's a lot of uncertainty. You know, it wasn't going down with the stock market in March in the pandemic. The biggest challenge with safe money, of course, is it doesn't make much money. So it does have risk. It has inflation risk. Can it keep up with the cost of living over time? The best way to beat inflation long term is the risk bucket. But of course, the biggest problem with risk money is you can lose a lot of money. Now, first off, it's important how we balance these buckets in retirement. Now, everybody's different. But one of the biggest challenges and mistakes that I see is there's an investment holding that many people think of as being in their safe bucket, but in reality, it should be in the risk bucket. And those are bond mutual funds. Bond mutual funds, with rare exceptions, are instruments that go up and down based on changes in interest rates. And when interest rates go up, they go down. And there's no stability or guarantees in a bond mutual fund that you'll ever make your principal back if interest rates go up and the values go down. Well, think about that. Think about where interest rates are right now. I mean, there's only one of two things that can happen. Either interest rates stay really low, in which case bonds aren't paying much, or interest rates go up and bonds go down. So they're absolutely at-risk investments unless the bonds in those funds are very, very short-term in nature. So bond funds go in the risk bucket, all right? So the balance of these two buckets is very, very important. Now, one of the most important things in the safe bucket is this is where we should be drawing money from with any needs we have over the next certainly 4 or 5 years at least, so that we're not depending on money that's in the stock market for our short-term needs. Because if we are, let's say I need money a year from now and it's in the risk bucket, well, I don't know where the stock market will be in a year. Nobody does. It's just a gamble. You might as well throw dice. So the safe money bucket not only provides some stability and certainty in bad markets, it also provides a place to go to draw money from where you're not going to realize big losses on your investments typically. Now then, the risk monies, that's your long-term growth. So the biggest key there is, number one, be focused on the long term. You don't need money from that risk bucket in the short term. The other problem, though, is in retirement, you don't have 25 or 30 years to wait to recover from a big loss. So how do you diversify inside that bucket to reduce some of the risk, but yet still have long-term growth? And using those traditional bond funds, I think, could be a really big challenge. That's kind of been the traditional way of hedging risk. Instead, we've got to look at all kinds of different asset classes. You know, when one investment zigs, another zags. That way, if one thing's way down like stocks or stock funds, hopefully they're not all way down. So the balance between these two buckets, how you can earn more money in the safe money bucket and provide for short-term income needs, and how you can provide long-term growth in the risk bucket but not have too much risk and have that right ratio of upside potential with downside risk. You know, it's all about balancing risk and reward. You need to measure that, balance it properly in a good financial plan.